Welcome to The Explainer. Today, we're diving into a really interesting first-of-its-kind fund from Edelweiss Mutual Fund. It's a hybrid index fund that's built to tackle some of the biggest headaches investors face. So let's get into how it's designed to make investing simpler and way more disciplined.
All right, to really get this, let's start with the challenges that make investing feel, well, kind of overwhelming sometimes. It really all boils down to three big questions every single one of us has to answer.
First up, the big one, selection. I mean, there are literally thousands of stocks and bonds out there. It's a huge universe of options. So where do you even start? How in the world do you pick the right things to put in your portfolio?
Okay, so let's say you've picked some assets. Now what? You've got the allocation problem. How much do you put in things meant for growth, like stocks, versus things meant for stability, like bonds? Nailing that balance is absolutely critical.
And finally, we have timing. The market is always moving, right? So that perfect mix you created will start to drift. The real challenge here is having the discipline to stick to your plan and not let fear or greed push you into making a bad call at the worst possible time.
Now, here's where it gets really cool. This new fund is basically built from the ground up to be an answer to all three of those questions. It's like getting a prepackaged, rules-based strategy right out of the box.
So, instead of you having to agonize over these decisions, the fund has them baked right into its DNA. It takes the guesswork out of the equation because it's designed to just follow a strict predefined index. Simple as that.
And this is its secret sauce, a fixed 70-30 split. The fund is literally hardwired to always keep 70% in stocks for growth and 30% in debt for that cushion of stability. That balance is the bedrock of the entire strategy.
And this shows you the two engines that are always working for you. The growth part tracks the Nifty LargeMidcap250 index, which gives you a piece of 250 of India's big and medium-sized companies. And for stability, that comes from government securities, which means zero credit risk.
So, okay, the strategy sounds good on paper, but let's look at the data and see how this combination has actually performed over time. Because a strategy is only as good as its results, right?
Now, there's a lot of data on this slide, but just focus with me on one key thing. If you look at the 10-year returns, they're pretty similar to the large cap fund category. But now look at the standard deviation. It's way lower. What that means in plain English is that the 70-30 index got you to a similar destination, but with a much less bumpy ride.
In this chart here, it really just hammers that point home. It shows you the performance you got for the risk you took. And that blue bar, our 70-30 index, is consistently the highest. So, for every unit of risk you put in, this strategy has historically given you a better return, period.
Okay, so beyond just the numbers, one of the most powerful features here is how the fund stays in balance. This is where it tackles that super tricky question of when should I rebalance?
Just think of it like having an automatic co-pilot for your portfolio. Every single month, the index gets reviewed. If stocks have a great month and your equity slice grows to, say, 75%, the system automatically sells a bit of that profit and buys more debt to get you right back to that 70-30 target. It forces you to buy low and sell high without you ever having to make an emotional decision.
And because it's all based on these simple rules, the fund is designed to avoid a bunch of common risks. You don't have to worry about credit risk because it's all government debt. And since the allocation is fixed and rebalancing is automatic, there's no chance of a fund manager trying, and maybe failing, to time the market.
Now, let's be super clear about something. A balanced approach does not mean a risk-free approach. So let's talk about the risks involved here and figure out who this fund is really a good fit for.
Look, even with that 30% in safer government securities, the fact is, the majority of this fund, a full 70%, is still riding the waves of the stock market. You are absolutely going to feel the ups and downs.
And hey, don't just take my word for it. The official Riskometer classifies this fund's risk profile as very high. That's a direct result of having so much in equities, and it's something you have to be completely comfortable with before you even think about investing.
So, who is this actually for? Well, it's pretty much perfect for an investor who's looking for a simple, all-in-one fund for both growth and stability. Someone who loves the idea of a passive, automated, low-cost approach and who's in it for the long haul. We're talking 5 years minimum. Basically, it's for the investor who wants to set it, forget it, and get on with their life.
So at the end of the day, what this all comes down to is a question for you. This fund offers a really unique automated way to balance growth and stability. The big question is, does this philosophy, one that chooses rules over gut feelings and discipline over emotion, does that fit with your own goals and how you want to invest?